Picture a charity that starts with a simple promise: raise money, buy powdered milk, and get it to starving children. Now picture the numbers drifting. Not in a dramatic way, but in a quiet, paperwork-heavy way that courts see all the time. The plan on paper talked about roughly $3,000 in projected contributions over the next couple of years. Then fast forward and we're looking around $26,000 coming in during the fiscal year at the center of IRS examination. That's not a gentle change. That's on the order of approximately $23,000 more activity flowing through the organization's account. And then court looks at what amount actually went to the stated mission: rice, soy, or powdered milk. And the answer for that year is essentially zero. So the money story becomes brutally simple. About $26,000 came in, and zero went to the mission that justified tax-exempt status. And the rest sat on the wrong side of the operational test. In other words, this is a story about a charity that, as IRS put it, was no longer fulfilling its exempt purpose. My name is Alex Dvorkin. I'm a certified public accountant in the state of California. And if you like this kind of stories from tax court cases, please give this video a thumbs up and subscribe to this channel. This channel reviews and analyzes U.S. tax court cases so that we can understand how U.S. tax law actually works. In this video, we cover the tax court decision in the case of Milk Saving Starving Children Foundation versus Commissioner of Internal Revenue. The opinion opens with a procedural posture that already hints at how this ends. The IRS filed a motion for summary judgment. The court ordered the organization to respond. The organization asked for more time. The court gave it more time, and then nothing meaningful arrived. The court says plainly, the organization did not file any further response or objection. That silence matters because in tax court, if you don't bring facts to fight a summary judgment motion, the court can treat the government's facts as undisputed for purposes of the motion. But the real heart of this case isn't the missing filing. It's the biography of the organization, what it said it would do, what it actually did, and what the IRS concluded from the paper trail. The organization was a Pennsylvania domestic nonprofit corporation incorporated in June 2001. In its application for recognition of exemption, it described its planned activities in a way that's so direct it reads like a mission statement you could print on a banner. It would raise money to purchase rice, soy, and powdered milk, solicit products from manufacturers, and distribute the milk worldwide to starving children. The application also said that in 2001 it shipped powdered milk to Ecuador and Haiti worth a little over $100. And it projected future contributions for 2002 and 2003. In the IRS's eyes, this was a charity with a clear charitable pitch: feed hungry children with donated nutrition. The IRS initially treated the organization as exempt under sections 501c3 and later classified it as a public charity. So at least for a time being, the paperwork lined up with the promise. Then the plot turns, and it turns early. Not long after the application date, the organization's board approved a plan to purchase and renovate a building and operate a coffee shop. The organization bought the property in 2002 for approximately $90,000, and a coffee shop opened there in 2003. The coffee shop was selling pastries and drinks with tables and chairs for customers, and that was a cash-only business. Here's the key detail that hangs over everything that comes later. The organization did not reference the operations of the café and the exemption application. Over the years, the real estate story grows. The organization planned an addition to the property, completed around 2009, and later rented that property to various tenants, including pizza shops and an Indian restaurant. So now the organization's day-to-day reality isn't just milk shipments. It's property ownership, renovations, leasing, and running a retail food business. Meanwhile, the milk mission flickers. The opinion describes powdered milk donations early on. There was an initial shipment in 2001. Later, the board discussed something called local milk shipments, but the records do not define what that meant. The organization reported on its 2008 tax return that it spent approximately $1,000 on milk donations, but by 2011 the court says the powdered milk donation ceased. And then comes a detail that feels like a classic the audit changed the behavior moment. Except, we're not going to speculate, so let's stick to the court's phrasing and timeline. The opinion says that sometime during 2020, after the IRS began examining the 2018 tax returns, the organization made some powdered milk shipments to 8 organizations that would distribute milk in places like Mexico, Haiti, and Peru, or to local community shelters in Scranton, Pennsylvania. But the record does not indicate the quantity or frequency of those shipments. There was also a golf fundraiser idea proposed in 2010, and the organization eventually held annual golf fundraisers, though the opinion says it was unclear how the organization used the funds raised. Now, all of that background is interesting, but the IRS didn't revoke exemption because it disliked coffee or golf. The legal hinge is where the organization was operated exclusively for exempt purpose. And the court explains that the phrase means in a way that matters for the story. Exclusively does not mean solely. But even a single non-exempt purpose, if substantial, precludes exempt status. The IRS zoomed in on one tax year, the fiscal year ending June 30th, 2018. The audit selection letter went out in September 2019. The revenue agent visited the property in November 2019 and interviewed the organization's secretary and principal contact, an officer who also worked at the café and was employed by the incorporator's law firm. During that interview, she said the mission had changed from distributing powdered milk, but she didn't elaborate. Then the audit got more document heavy. The revenue agent reviewed 2018 financials, cash receipts, expenses, bank statements, and looked at a lease for the addition to the property. The addition was being rented out for about $1,000 a month as described in the opinion, and the tenant was responsible for maintenance and utilities. The books and records showed that the rental income from that addition was directly deposited into a bank account to pay off a loan secured by the property. After that first round, the revenue agent sent a long series of information document requests, 11 more, seeking more detail and clarification, including clarification of what the organization meant when it said its mission had changed. The officer responded to request and acknowledged a key fact. The organization had not conducted charitable powdered milk distribution during the year 2018, and it had not done so for several prior years. She wrote, in words the court quotes, that the foundation was established to provide vitamin-fortified powdered milk, but the want for this decreased after 2011. That's a pivotal sentence in the narrative because it's the organization itself telling the IRS that the original mission wasn't happening anymore. And once that's admitted, the organization tries to fill the gap by describing other charitable activities. Running a charity golf tournament, selling baked goods at the cafe, donating proceeds and baked goods to other charities, purchasing items from other charities, or donating to other charities. But the IRS isn't persuaded by a list of good intentions. The IRS wants proof where the money went. So the revenue agent identifies the organization's primary source of income as rent and golf fundraiser proceeds, and then the opinion gives us the 2018 numbers that become the backbone of the IRS revocation theory. For that 2018 year, the organization's books and records showed total income of approximately $26,000, $2,000 coming from café sales, about $6,000 from rental income, another $13,000 from golf fundraiser proceeds, and another $6,000 in donation. Total expenses were also around $26,000, including about $2,000 in golf tournament expenses, another $4,000 in salaries, approximately $1,000 in baking supplies, and $2,000 in insurance, and $6,000 in mortgage payments, and around $2,000 in air conditioning repairs. One line item jumps out because it's exactly the kind of thing that makes the IRS squint. loaned to the incorporator, totaling approximately $9,000. And the court states flatly that none of the 2018 expenses were for rice, soy, or powdered milk. At that point, the IRS sent a proposed adverse determination letter in June 2021 laying out the theory in blunt terms. The letter said the organization is no longer fulfilling its exempt purpose, that it ceased milk distribution activities over the last several years, and that it recently began distributing milk in response to the potential revocation. Then it goes after the core activity, operating the café to raise funds, was neither charitable nor educational. The letter also emphasized that the primary revenue sources were renting property and the golf fundraiser, and that funds raised were not used for charitable purposes, as demonstrated by the table of revenue and expenses. The organization's representatives continued communicating with the revenue agent and claimed they had been active and had placed orders for powdered milk, including some canceled orders because milk was out of stock. The opinion notes they provided receipts showing some successful purchases shipped to the café address, but when the revenue agent asked for broader current financial documentation from January 2020 through June 2021 to show the organization was expending funds for its exempt function, the organization did not provide that information. Then came the final IRS move, a final adverse determination letter in February 2022 revoking the organization's Section 501c3 status effective July 1st, 2017. The organization petitioned the tax court for declaratory judgment, and that brings us back to the court's role. It's reviewing the administrative record, not holding a brand new trial, and it's assessing whether the IRS stated reasons for revocation were proper. The organization bore the burden to show the IRS was wrong. On summary judgment, the court repeats the basic idea. The moving party has to show there is no genuine dispute of material facts, but the non-moving party has to respond with specific facts showing a real dispute for trial. Here, the court says the organization didn't do that despite being directed and given extra time. Still, the court doesn't just win by default the case. It walks through the operational test. It emphasizes that what matters is the purpose the activities serve, not whether the activities can be described as nice. And then it lands on the key factual pattern the IRS relied on. The organization stopped doing its original milk distribution mission for years, engaged extensively in commercial activities like operating the cafe, renting the property to unrelated commercial tenants. It did not show that those commercial activities furthered an exempt purpose. There is also a moment when the court deals with the organization's broad claim in its petition. The organization asserted it had received substantial contributions and that it was publicly supported and in compliance. The court responds in a way that is devastating. Yes, the record supports that it received contributions, but the record doesn't show it dispensed those contributions in support of its exempt purpose. And for 2018 year specifically, the court highlights that it received income of about $26,000 and did not make payments or donations in support of its exempt purpose. And that claims of donations to other charitable causes weren't supported by the records, including that the organizations reported no such donations in 2018. So the ending is exactly what the opening warned us was coming. The court grants summary judgment to the IRS and upholds the revocation. It concludes the organization failed the operational test and therefore did not operate exclusively for exempt purpose under Sections 501c3. Because it failed the operational test, the court says it doesn't need to address whether the organization was organized for a charitable purpose. And the lesson here is that we used to do the charitable thing is not a substitute for we're doing the charitable thing. And we raised money is not the same as we used that money for exempt purpose. If your books show a lot of commercial motion and essentially none of the mission spending that justified the exemption, the operational test is going to read your story back to you in the harshest possible tone. My name is Alex Dvorkin. I'm a certified public accountant in the state of California, and if you like this video and found this information useful, please give us thumbs up and subscribe to this channel. And I'll see you in the next tax court case review.